What if the very institutions we rely on for economic stability are on the verge of collapse? Imagine this: Silicon Valley Bank, a titan of the industry, buckling under the strain of an asset-liability mismatch and a run on deposits. It's not a scene from a Hollywood movie, but a recent reality. A financial drama played out in real time as the bank failed to keep its head above the turbulent waters of inflation and rising interest rates. Picture the panic that ensued. Depositors fearing for their hard-earned money started withdrawing en masse, leading the bank down the slippery slope to insolvency. It was a scene reminiscent of the banking crisis of the last century, only this time it was the second largest bank failure in U.S. history. But then, in stepped the U.S. government. In a bid to stem the contagion, it guaranteed all deposit accounts at both Silicon Valley Bank and Signature Bank in New York, which was also experiencing a run on deposits. The banking system, they proclaimed, was safe. Across the pond, the UK government took action to protect customers of Silicon Valley Bank's UK subsidiary, selling it off to HSBC. It seemed that the global crisis had been averted and the banking system once again was deemed safe. But how safe is it really? These questions linger in the air, unanswered and ominous. Could the very foundations of our economic system, the institutions we entrust with our livelihoods, be more fragile than we think? These events serve as a stark reminder of the precariousness of the financial world. And so we turn to one of the world's leading financial thinkers for insight. A man who has been at the forefront of the finance world for decades, who has seen the ups and downs, the booms and busts. A man who isn't afraid to ask the hard questions. Stay tuned as we delve into a conversation with Ray Dalio. Today we have the privilege of hearing from Ray Dalio, renowned investor, hedge fund manager, and philanthropist. In our imaginary conversation today, Dalio would likely begin by discussing the recent SVB crisis. The Silicon Valley Bank crisis, he might say, is an example of what can happen when there's an asset-liability mismatch and poor financial management in times of economic instability. The bank was caught off guard by inflation and rising interest rates, leading to a run on deposits and eventually insolvency. He would likely emphasize the importance of understanding the mechanics of such a collapse. It's not just about one bank's failure, he might point out. It's about the domino effect that can occur when one major financial institution falls. The panic that ensued led to a run on deposits at Signature Bank in New York, revealing just how interconnected our financial institutions are. Dalio would probably go on to discuss the role of government intervention. The U.S. government stepped in and guaranteed all deposit accounts at both banks, he might say. This was a necessary move to stop the panic and reassure the public, but it's also a stark reminder of the role that governments play in our financial systems. He would also likely touch on the global impact of such a crisis. The UK took action to protect customers of SVB's UK subsidiary by selling it to HSBC, he might note. It's a reminder that a crisis in one country can have repercussions around the world. Dalio would probably then pivot to discussing the future. The potential for a banking collapse is a real and present danger, he might warn. We need to learn from the SVB crisis and take steps to prevent a similar situation in the future. We need to ensure that banks are managing their finances responsibly, particularly in times of economic instability. He might end our conversation on a note of caution. The financial world is more interconnected than ever, he might say. A failure in one part of the system can quickly ripple out and affect the whole. We need to be prepared for that. As Dalio points out, the potential for a banking collapse is a real and present danger. Let's turn our attention to another potential financial pitfall: investing in China. Recently, a series of events have raised the alarm about the stability of pouring funds into the Chinese market. One such event was the investigation launched into Didi Global, a ride-hailing app, mere days after its debut on the New York Stock Exchange. This incident led to a staggering loss of $29 billion in market value. China has also proposed new regulations requiring large tech companies to undergo cybersecurity reviews before listing on overseas markets. This move has caused several Chinese companies to hit the pause button on their plans for initial public offerings on Wall Street. However, these are not the only concerns. Chinese stocks also pose risks due to regulatory loopholes that enable companies to evade oversight and keep investors in the dark about their financial health. Chinese companies often employ a legal structure known as a variable interest entity, or VE, to sell shares overseas. This involves setting up shell companies in tax havens, allowing Chinese firms to masquerade as foreign entities, thus sidestepping restrictions on foreign ownership. But it doesn't end there. The lack of transparency in Chinese companies listed on U.S. exchanges has been a cause for concern. The Chinese government has consistently refused to allow U.S. regulators to inspect their audits. This refusal only serves to heighten the level of risk and uncertainty for investors. To put it plainly, investing in Chinese stocks carries significant risks due to these regulatory uncertainties and the overall lack of transparency. The China Securities Regulatory Commission is reportedly planning rule changes to close these loopholes. But until then, investors should tread with caution. The uncertainties surrounding Chinese investments only add to the potential for a global banking collapse. In these uncertain times, it's more important than ever to stay informed and prepared. We're standing at the precipice of a potential banking collapse, with the fragility of our financial institutions laid bare for all to see. The recent crisis at Silicon Valley Bank and the associated tremors in the market underscore the importance of understanding the financial landscape and the institutions we entrust with our hard-earned money. Furthermore, the allure of foreign markets, such as China, can be enticing, but the risks are substantial. Regulatory uncertainties, lack of transparency, and complex legal structures like the variable interest entity can make these investments a veritable minefield. The key to navigating these troubled waters is knowledge and awareness. Educate yourself about the potential pitfalls and risks, and most importantly, diversify your investments to spread the risk. In the words of the wise, don't put all your eggs in one basket. Instead, consider a balanced portfolio that can weather the storms of economic uncertainty. Thank you for watching The Big Reset Investment. If you found this video informative, please give it a like and don't forget to subscribe to stay updated on the latest financial news and insights.